Hello, I'm Peter Mauthe. I'll be your presenter today for the presentation by Trademark Capital Management on our post-election economic and market expectations. I've got a number of slides to go through today, so I'll be fairly quick so I can keep our time at a minimum. Let's go on to our second slide, which is the election results. As we all know, the president is Republican. The House of Representatives in Congress is Republican. The Senate also has a Republican majority. And what this means is that there will be little friction in Congress in passing Republican-sponsored legislation. Now, the economic expectations is clearly defined by President-elect Trump. He will be tightening borders, imposing tariffs, he will extend existing income tax reductions, and also increase fiscal responsibility or lower deficits. Now, that's what's been stated. We'll see if that can actually happen. Also, there is a great expectation for lower interest rates. Now, let's take a look at this in a little bit more detail. Tightening the borders means that as a national economy, we will probably see labor shortages in farming, construction, landscaping, and other basic labor-related industries. Imposing tariffs while increasing inflation, that's a short-term phenomenon because tariffs are usually a one-and-done type occurrence. There may also be some supply disruptions as the increased pricing impacts certain industries. Extending the existing income tax reductions, however, will provide economic stimulus, but they will also promote further deficits and an increase to our national debt. Increased fiscal responsibility, which is something that nearly all Americans would hope for. However, it is unlikely no matter who's in Congress and who's in the White House, simply because our elected officials have a tendency to avoid at all costs cutting their expenditures in their respective districts. Now, lower interest rates are almost certain to happen throughout 2025 and into 2026, but here's how that will look. Before I get to that slide, let's just highlight the fact that for the last 20 years, we have seen the deficit in the United States get deeper and deeper and deeper. That's just the 20-year trend we're on. We haven't seen a balanced budget, which is this horizontal line at the top of this graph. We haven't seen a horizontal I beg your pardon, we have not seen a balanced budget or a surplus this century yet. And based on our lack of fiscal responsibility, there is unlikely one in our near future. Now, what's this mean for our national debt? Well, this is also a 20-year graph showing the escalation in our national debt. However, this took on a whole new trajectory in 2020 when COVID came into play, and that trajectory is still in play today. Ending 2024, we currently have about $36 trillion in national debt, and that is likely to climb at around $2 trillion a year in the coming years. Now, interest rates. This is a graph created by Tom McClellan at McClellan Financial Publications, which does a really great job of showing the leading two-year Treasury note yield, which leads on the way up and on the way down typically. The black line represents Fed funds target rate as established by the Federal Reserve Board. And you can see that for about a year now, even a little bit longer, the two-year Treasury note has been forecasting that the Fed indeed will lower rates. It's continuing to indicate that, and the general market consensus today is that we will end up with short-term interest rates, meaning Fed funds rate, down around a 3% level sometime in late 25 or early 26. Given that expectation, this is what we can expect from interest rates. Well, this is the yield curve as of about the end of October. Yield curve being nothing more than the interest rate on various maturities of federal debt in this case. And you can see that the interest rates controlled by the Fed, the very short-term interest rates, if they go to 3%, have a long way to drop to get down to 3%. However, the rest of the bond market at 5 years and out have already declined to the level that we would expect them to be at should short-term interest rates fall to 3%. So don't expect longer-term interest rates to fall. That means auto loans, which are tied to fairly closely to the 5-year Treasury note yield, don't expect car rates to fall even though short-term interest rates fall. And don't expect home mortgages to fall significantly either if short-term interest rates fall, because the home mortgages are tied to the 10-year Treasury note. Those loans may fall just gradually, while we can see very short-term interest rates will fall fairly significantly in the foreseeable future. Now, what does that mean for the stock market? At Trademark, we don't really make forecasts. We have a tendency to follow where the market leads us and manage portfolios accordingly. But you can see that this weekly chart of the S&P 500 covering the last going on 5 years, since the 22 decline in stocks and bonds, the advance we've seen in the S&P 500 is still well intact. It does not seem to be a threat at the present time. And you can see that the two indicators that I have here are suggesting that the trend also is intact via these two indicators. Now, this can change on relatively short notice, and that's why we do not have fixed portfolios. Our portfolios can change as market conditions change. We'll take a look at this in the months to come to see how these expectations are playing out in the real world. In the meantime, you can follow Trademark at our website, trademarkcapital.com, on X, formerly known as Twitter. You can follow some of our videos on YouTube, as well as on LinkedIn. If you have a request for future videos, please don't hesitate to contact us and give us the subject material. In the meantime, good luck and stay tuned. Thanks for joining us today.